6.37%. That's the number flashing across every mortgage rate tracker right now. If you're sitting on a 7% loan from 2 years ago, this number should make you very uncomfortable. Because there's a hidden math problem buried inside your mortgage, one that's quietly draining your bank account every single month. And almost nobody is talking about it. Here's what you'll walk away knowing today. By the end of this video, you'll have one simple formula. It tells you, down to the exact month, whether refinancing saves you money. You'll also get a 4-step decision tree you can screenshot and use tonight. No guesswork, no opinions, pure math. Quick note before we dive in, I'm not a financial advisor. This isn't personalized advice. It's what the data shows and what the math says. Always do your own homework before making money moves. Cool, let's get into it. So here's where we are in March 2026. Mortgage rates just jumped hard. The 30-year fixed averaged about 6.18% early this year. That was actually pretty encouraging. In February, some borrowers locked in rates in the high fives, lowest we'd seen in a long time. People got excited. Articles started saying the window is opening. Buyers jumped in. Refinance applications climbed. Then everything changed. Oil prices spiked. Geopolitical tension escalated. The 10-year Treasury yield climbed to nearly 4.4%. And that Treasury yield, that's the number that actually drives mortgage rates, more than anything the Fed does. Speaking of the Fed, they met in mid-March, held rates steady at 3.5 to 3.75%. No cut, no relief, no signal that relief is coming anytime soon. So rates went up, and the reaction from most homeowners was predictable. They froze. They said, "I'll wait." They closed their laptop and moved on. But here's the number that should really grab your attention. A homeowner who locked 7% in 2023 on a $300,000 loan, they're paying roughly $125 more per month than someone locking today's rate. That's about $1,500 a year, sitting right there on the table, unclaimed. And get this, refinance applications dropped 15 to 19% in a single week. The moment rates ticked up from February's lows, people panicked and walked away. They walked away from $1,500 a year because of a half-point rate move. So who's actually right here? The people who refinanced in February, the people refinancing now, or the people waiting for something better? That's exactly what we're going to figure out. Coming up in a few minutes, the exact break-even formula. It answers this question perfectly. It's a simple division problem, takes 30 seconds. But first, why did this rate spike happen? And why does it matter more than most people realize? Most people hear 6.37% and they think one thing: rates are going up, I missed it. They feel like they're watching a train pull away from the station. And that feeling is paralyzing. I get messages every week from people saying the same thing. I was about to refinance in February, then rates jumped, now I don't know what to do. Sound familiar? Here's the thing, that freeze response is completely natural, but it's also extremely expensive because while you're frozen, your old rate keeps charging you every single month, like clockwork. But here's what they're missing. 6.37 is still below the average rate in 2023, below 2024, below most of 2025. And do you see the trend? Rates are still coming down over time. This month's spike doesn't erase 2 years of gradual decline. But the real trap isn't about this month's rate at all. The trap is the belief that you need to wait for a specific magic number. Here's a stat that blows my mind. 45% of recent home buyers are waiting for rates to drop below 5% before they'll even consider refinancing. 5%. No major forecaster expects rates to hit 5% within the next 3 years. Some say it could take even longer. The most optimistic projections for the end of 2026? Rates may be dipping just below 6%, maybe, if inflation cooperates and the geopolitical situation calms down. Nearly half of recent buyers are frozen, waiting for a number that isn't coming anytime soon. That's the trap. It's not that rates are too high, it's that your expectations are anchored to a fantasy. So here's the real question. It's not when will rates hit 5%. It's does the math work right now, today, at 6.37? And I'm going to show you exactly how to answer that. This is the single most important calculation in all of mortgage refinancing. And here's the beautiful part. It takes about 30 seconds. No spreadsheet, no financial advisor appointment, one formula. Total closing costs divided by monthly savings equals your break-even point in months. That number tells you how many months until your savings cover the refi cost. Every month after that break-even point, pure savings. Let's run a real example right now with today's numbers. Say you bought a home in late 2023. You locked a 30-year fixed rate at 7%. Your loan amount is $300,000. Pretty standard. At 7%, your monthly payment is about $1,996. Now let's say you refinance today at 6.37%. Your new payment drops to about $1,871. That's a savings of roughly $125 per month. Now, closing costs. This is the part most people forget about. Refinancing isn't free. You're essentially taking out a new loan, and new loans come with fees. The average refinance closing costs run about 3 to 6% of your loan amount. On a $300,000 loan, that's $9,000 to $18,000. But don't close this video yet. Most people don't pay the high end. Let's use a realistic middle estimate, $6,000. That's around 2% of the loan. Very achievable. Now plug it in. 6,000 divided by 125 equals about 48 months. 48 months. That's 4 years. So if you plan to stay in your home for more than 4 years, refinancing from 7% to 6.37% saves you money. Full stop. And after those 4 years, you're saving $125 every single month for the remaining life of your loan. Now let's run a second scenario, because not everyone bought at 7%. Say you locked at 6.75% in mid-2024. Same $300,000 loan. Your monthly payment is about $1,946. Refinance today at 6.37. New payment is $1,871. That's only $75 per month in savings. Run the formula. 6,000 divided by 75 equals about 80 months. Almost 7 years to break even. That's a long time. The average homeowner stays in their home about 7 to 10 years. If there's any chance you move before month 80, you lose money on that refi. See how the same formula gives you completely different answers depending on your situation. That's why this formula matters more than any headline about rates. Now let's look at a third scenario, the sweet spot. What if your closing costs are lower? Some lenders charge as little as $3,000 on a streamlined refinance. No appraisal, reduced fees, coming from 7%. 3,000 divided by 125 equals about 24 months, 2 years. That changes everything. 2 years to break even. If you're planning to stay put, you should seriously consider refinancing. Which brings us to the most important lesson in this entire video. Now here's the part most people skip. Don't skip this. That formula only works if you use your real numbers. Not national averages, not your neighbor's numbers, not what some article told you, your actual closing costs, your actual rate, your actual savings. Because closing costs vary wildly between lenders. One lender quotes $8,000, another quotes $4,000 for the exact same loan. That gap alone can cut your break-even point in half. The move? Get at least 3 loan estimates. You can do this online in about 20 minutes. Compare the closing costs on each estimate line by line, then run the formula 3 times. Take the best number. Here's something else most people miss. You can shop multiple lenders within a 14-day window. It only counts as one credit inquiry. 1. The credit bureaus bundle them together, so there's no excuse not to compare. And here's one more trick. You can ask for a no closing cost refinance. The lender covers your closing costs, but they bump your rate slightly higher, usually about 1/4 to 0.5%. The trade-off? No break-even period at all. Your savings start immediately, but the monthly savings are smaller, and you pay more interest over 30 years. This is a fantastic option if you think rates will keep dropping. You refinance again in 2 or 3 years, you save a little now, pay no upfront costs, refi again later when rates fall further. Now let me show you the #1 mistake I see people making. And honestly, it's costing some homeowners thousands. They're chasing a dream rate. They say, I'll refinance when rates hit 5% or 4.5 or even 4. They're anchored to the pandemic era rates they saw in 2020 and 2021. And I get it, those rates were incredible, below 3% in some cases. But those rates were a historical anomaly. They were emergency rates during a global crisis. They're not coming back anytime soon, and waiting for them has a very real cost. Let's do the math on waiting. Say you're overpaying $125 per month. That's roughly the gap between 7 and 6.37%. On a standard $300,000 loan, you wait 12 months for something better. That's $1,500 gone, not deferred, gone. You never get those months back. Wait 24 months? That's $3,000. Wait 3 years hoping for 5%? That's $4,500 in unnecessary payments. Let me put that in perspective. $4,500 is a nice vacation. It's 3 months of car payments. It's a solid start on an emergency fund. And you didn't lose it because of bad luck. You lost it waiting for a number on a screen to hit 5. And you might still not get 5% after waiting 3 years. Here's what the forecasters are actually saying. Most forecasters project rates between 6 and 6.5% for 2026. The most optimistic outlook, rates may be dipping below 6% by year's end. But 5%, not in any major forecast for the next 3 years. Every month you wait for that number, you're paying for a ticket to a show that might never start. The fix is dead simple. Stop watching rate headlines. Start running the break-even formula with today's numbers. If the math works today, act today. You can always refinance again later if rates drop further. That's called the serial refi strategy. You don't need to time the absolute bottom. You just need the math to work each time. That's not a gamble, that's a system. Coming up, the full decision tree. A yes or no flowchart that puts all of this together. It takes about 60 seconds to walk through, and it tells you exactly what to do next. All right, this is the part you screenshot. Seriously, pause the video and screenshot this if you need to. I'm going to walk you through 4 questions. Answer them honestly, and you'll know exactly whether to refinance, wait, or stay put. Question 1. Is your current rate at least 0.5% higher than today's average? Right now, today's rate is around 6.37%. You'd need to be at 6.87 or higher. If no, stop right here. The savings from a refi that small won't cover your closing costs in time. Stay put for now. If yes, move to question 2. Question 2. How long do you realistically plan to stay in your home? Be honest with yourself here. Don't say forever if you've been browsing Zillow in a different city. Think about your actual plans for the next 3 to 7 years. If less than 3 years may stop, you almost certainly won't break even on closing costs. Stay put. Or explore a no closing cost refi. That's the one exception. If 3 years or more, you've got room for the math to work. Move to question 3. Question 3. Run the break-even formula. Get your actual closing cost estimate from a lender. Divide it by your actual monthly savings. Is your break-even point shorter than the number of years you plan to stay? If no, the math doesn't work yet at this rate. Either wait for rates to drop slightly, or ask your lender about a no closing cost option. If yes, this is your green light. Start getting loan estimates from at least 3 lenders. Lock it in. Question 4. This one is optional but powerful. Can you refinance into a shorter loan term? If you're 5 or 6 years into a 30-year mortgage, think about a 20-year or 15-year loan. Why? The 15-year mortgage rate right now averages around 5.78%. That's more than 0.5% below the 30-year rate. Your monthly payment might go up a little, but you'll build equity dramatically faster and save a massive amount in total interest. On a $300,000 loan, the total interest difference is enormous. We're talking 30-year versus 15-year. We're talking over $175,000 in total interest savings. Got a raise since you bought, paid off other debt, have more breathing room? Shortening the term is the real power move. There's one more thing you need to know, and I haven't seen a single mainstream article connecting these dots. In May 2026, Kevin Warsh is expected to replace Jerome Powell as chair of the Federal Reserve, if confirmed. That's barely 6 weeks from right now. Now, the Fed doesn't directly set mortgage rates. That's a common misconception. Mortgage rates follow the 10-year Treasury yield much more closely. But the Fed chair sets the tone. Their speeches, policy signals, posture on inflation, all of that moves the Treasury market. And the Treasury market moves mortgage rates. Nobody knows exactly what Warsh will do. Rates could go up, rates could go down, they could stay right where they are. But here's what we absolutely know. Leadership transitions create uncertainty, and uncertainty makes lenders nervous. When lenders are nervous, they widen the spread. The spread is the gap between the treasury yield and your mortgage rate. Normally, that spread is about 2 percentage points, but in uncertain times, it gets wider. A wider spread means higher rates for you, even if treasury yields stay flat. That spread has already been widening in March. So if you've been going back and forth about refinancing, here's a practical tip. If the decision tree gives you a green light, consider locking your rate before May. You can lock a rate for 30 to 60 days with most lenders. Some even offer a float down option. If rates drop during your lock period, you get the lower rate. Best of both worlds. Ask your lender about a rate lock with a float down provision. It protects you from volatility while keeping the door open for improvement. Because the one thing that always happens during transitions, volatility. And volatility is not your friend when you need to lock a rate. Let's bring this home. Here's what you now know. 6.37% is not a disaster. It's not a dream rate either. But for anyone sitting on a 7% loan from 2023, the math might already work. And you've been leaving money on the table every single month you didn't check. The break-even formula is your compass. Closing costs divided by monthly savings. That's it. That one number tells you everything. Don't chase a fantasy 5% rate. Run your numbers today. Get 3 loan estimates. It takes 20 minutes. Compare closing costs. And if the break-even point is shorter than your time in the home, act. Consider a no closing cost refi if you think rates will keep dropping. Consider a 15-year term if you've got the income. And consider locking before the new Fed chair takes over in May. That's the decision tree. That's the formula. And if you screenshot one thing from this video, make it those 4 questions. One last thought. 74% of recent home buyers say they plan to refinance eventually. Eventually is the most expensive word in personal finance. Don't be eventually. Be, I ran the formula and I know my number. That's the move. Money made simple. If this was useful, you'll want to see how to build an emergency fund on any income. And it's the one most people fail. I'll link it right here.